Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's episode, we are joined by Zach Lemaster, CEO of Rent to Retirement. Today, Zach's going to share about how he turned his optometry career into a full-time real estate investment business where Rent to Retirement will help investors find out-of-state A-class turnkey deals and set it all up for you, guide you in the right direction, connect you with the right people. And we're going to hear about how some of those connections can create pretty good deals on A-class properties in today's current market. Now let's welcome Zach Lemaster. All right, welcome to the Westside Investors Network. We got Zach Lemaster, the CEO of Rent to Retirement, joining us today. Zach, thanks so much for taking the time to chat with us.
Yeah, Trent, I'm excited to be here. Thanks for having me.
So Zach has accomplished what I think a lot of our listeners and a lot of people want to accomplish, where you're in a career and you want to get to real estate full time. You maybe start while you're still working that career instead of just going headfirst and burning the ships and going right for it. So I want to talk with Zach today about how you accomplish that goal of getting full-time in real estate and being able to practice optometry when you want and for the good of the people. So yeah, go for it.
Well, I mean, just to kind of fill you on my story, the first thing I'll say, Trent, is that I never had a goal to replace my income. That was actually not something that was an ambition of mine. I really enjoyed optometry, and I'm still passionate about that. My wife is also an optometrist, but now we have the ability to practice really just on a volunteer basis. We have a lot of humanitarian efforts that we put our energy into. We set up cataract clinics internationally in underdeveloped areas that don't have access to eye care. So, but my point is that we're able to do that really like on our schedule, and we're actually able to have a bigger impact globally because of what real estate has allowed us to accomplish. But yeah, I never anticipated to like replace my W-2. I know that may be an ambition for a lot of people, and that's great. But you can still, I mean, regardless of really what you want to do out of real estate can fit multiple different aspects of your lifestyle, really, and it can start as a side hustle. That's a beautiful thing. But yeah, so my wife and I were optometrists by education. We met in school. I was on a scholarship with the Air Force, HPSP scholarship. So I was commissioned as a captain in the Air Force right after I left optometry school. I practiced optometry there for, 6 or 7 years. That's where I started investing. I started investing in real estate just because, like many people, I probably read a lot of the books and the Rich Dad, Poor Dad stuff, and just was like, hey, this seems like an interesting thing. And I could understand real estate. It's tangible. First house I bought, used a VA loan, no money down, bought a duplex, lived in half, rented out the other half. And this is probably about 14 or 15 years ago at this point when I bought that first house. That was my first primary residence. And I just got hooked. I liked the idea of buying an asset, using other people's money, i.e. the bank, that the tenant basically pays off for you over time. And then you get all the the appreciation, the tax benefits, and benefit of leverage and things like that. So the next year after that, we bought a few more deals and just consistently bought real estate. I didn't have like necessarily a big plan, and we went slow in the beginning. We invested locally to start, but there was a pivotal moment, Trent, where we started to look out of state in different markets that we found better opportunity, areas that were more conducive with our goals, areas that had better appreciation and just better opportunity to really like take advantage of real estate and the path of progress. And so we started to invest out of state across multiple different markets. And, there's obviously some bumps in the road with that, but we kind of figured it out, always improved our systems. And that was the birthplace of Rent to Retirement. We kind of built this business by accident, just out of necessity of building a systematic way for our own investing to find the best markets and build the teams and systems in those areas so we can strategically invest in areas that offer the best returns, and we had a lot of friends and family and colleagues that were like, hey, we see what you're doing in real estate. Can we invest with you, or can you help us? We don't have the time or experience, or local market's too expensive, whatever the case is. And we started to help them just follow the same path that we did. And fast forward, probably from that point, about 10 years later, where we're at today, we obviously have a pretty robust company that helps people buy deals across the country where the returns are attractive, and we have all the teams set up so they can be somewhat passive. You don't have to self-manage or do everything from your own on the ground floor. And so, yeah, it's that's kind of the story. I mean, we're across 18 different markets, and we'll probably do about 800 doors this year. But I mean, I've always just kept my nose down and just kept investing in real estate and doing more, right? Even though I didn't necessarily have the plan to be where we're at today.
I got a couple questions for you from the early years when you and your wife were first getting started. When you were first starting out, were you focused on assets that had better cash flow or better appreciation when you were first getting going to those first handful of deals?
Yeah, it's interesting and that is a spectrum. I think a lot of people think it's either or. I've come to find out you can actually have both, just in the right market. And that's really where we focus today, is new construction. But in the early years, I would say, and I think this is probably true for a lot of people, is I was really just focused on cash flow because that's tangible. I wasn't too forward thinking. I was just like, hey, if I have, whatever, $400 a month in net cash flow, if I can buy 10 of those houses, that's $4,000 a month, $48K a year, pretty much tax free because of how real estate works, right? So that could be the equivalent of 60 or 70K earned income. But I was like, so that makes sense, and it's tangible. Those were the early years. In future years, I learned that you actually truly build wealth in real estate, focusing more on cash flow as a byproduct, but you focus on, appreciation, the tax benefits, and how to strategically scale and trade up 1031 cost seg, those types of things. But early years, yeah, cash flow.
And the reason I asked that, because I think a lot of people, like you said, are focused on cash flow to start because it is tangible. One thing that I've noticed from my wife's perspective, she's a nurse, and I don't know if it's just the industry or people that you get paid every 2 weeks. A lot of people tend to think on a monthly basis. And so if they see the cash flow coming in every month, that just lines up with their thought process on finances in general. But to your point, being able to get both is great. But in the early years, I have experienced that the appreciation side, while you're still working and making money from other avenues, typically is more beneficial down the road.
Yeah, and I couldn't agree with you more. And that's a good point. Most people do think on a monthly or biweekly basis because that's the income and expenses, right? And there are a lot of people that live paycheck to paycheck, and if you can, carve out some extra money to invest, that's kind of the first step. But yeah, learning about appreciation and understanding, I don't think I truly knew the math of real estate. I don't think I truly understood in the early years how real estate worked long term. We refer to real estate as the ideal investment, and that's an acronym for all the ways you earn income. So I is cash flow, right? That's your income. D is depreciation and tax benefits, which now, honestly, that's the most important thing we pay attention to, because we have a successful business and our goal is to buy enough real estate every single year to completely wipe out our taxes, which can be accomplished with real estate if you do it strategically. E is equity, as the tenant pays a loan down. A is appreciation, as you mentioned, all homes go up in value regardless of short-term fluctuation. And then L is leverage, being able to leverage properties. That's what really separates real estate out from other asset classes. But yeah, I think most people think about cash flow because it's tangible. They can see it, they can feel it, they can calculate it. But if you learn how to run the math and understand before thinking 5 or 10 years what a property could be, I think that will affect a lot of the decisions you make early on in investing. And most people are not trying to retire tomorrow off of cash flow, right? So to your point, if you're having a W-2 income and a job, that's a really good thing to be able to qualify for good loans, to buy properties with a 10-year plan or whatever the case is.
And you've mentioned depreciation and the tax benefits a couple of times. And in your example, you said if you can cash flow $400 a month and get 10 of them, that's $48K a year. Obviously, neither of us are tax professionals, so there's my disclaimer. Can you give a high-level overview of when you understood the tax benefits and depreciation, and like you said, buying enough deals to wipe out that income? And what's your high-level overview or your benefit to investing in real estate on a tax depreciation side?
Oh man, Trent, you're going to get me going here. I could, you cut me off because I can talk all day about this. And I do on our, YouTube and podcast stuff. Cause we bring in our tax professionals to actually, break this down for people. But I think in general, if you're talking big picture, there's three main things that really separate, three main tax benefits. There's a lot of tax benefits, and I won't even get into like the estate planning and the step up basis where you can, perpetually defer depreciation and never pay taxes on real estate potentially. But like just in the early stages. So one is cash flow. We refer to that as tax-free income. If you're leveraging property and you're accounting for all your expenses appropriately, tax, insurance, your mortgage, your normal depreciation, which everyone takes, all the expenses, all the taxes, all the stuff on the property, those are all tax deductions, right? Those are all write-offs. And so the reality is, what I found is that most property that we buy, even though we have positive cash flow, that cash flow is tax-free because it's just the normal write-offs. And so that's really powerful if you think about it, especially if you live in a state that has, taxable income. But even just from a federal standpoint, like taxes are the biggest expense we're all going to pay in our life. And that's the easiest way to give yourself an immediate raise, that then you can have more tangible capital to go and invest in other assets that have additional tax benefits, and you get the snowball. So that, like, just paying attention to the tax benefits allowed us to really scale our portfolio to the point where we were able to replace our active income. I would say that's the one thing that allowed us to truly replace our active income and professional income, right? Dual professional income within 5 to 6 years is utilizing the tax benefits. So if you have $100,000 of income from your rental portfolio, that's probably the equivalent of $160,000, $170,000 of earned income, possibly more, depending where you live, right? That's extremely powerful. So that's the one thing, is just tax-free cash flow. The next thing is 1031 exchanges. This is absolutely huge, right? And this isn't going away. I know there's a lot of 1031 exchanges. And the IRS, I'll say this too, the IRS incentivizes us as real estate investors to stimulate the economy, to create jobs, to create housing solutions for people. So the IRS will always incentivize us as real estate investors to go out and do these things that they are incapable of doing themselves. And that's the benefit of being in the real estate industry. 1031 exchange, basically you buy a house for $100,000, later it's worth $200,000, you sell it, and normally you'd had capital gains on that if you hold it for longer than a year, which can be dramatic on your income on that property, but you're allowed to roll it into more property, and defer those capital gains, which you can do perpetually forever if you structure it appropriately. That's really powerful because instead of paying, whatever, 25% on your profit, that's an extra 25% that you don't have to pay, and you can reinvest in more real estate that, again, has additional tax benefits. So we did a lot of those. The first portfolio of properties that we created within the first 2 to 3 years, we let those build equity over time through appreciation and the tenant paying the loan down. And then within 4 to 5 years, we went through our first 2 1031 exchanges, and we were able to double our portfolio size, almost triple it, without putting any more capital in, right? We just used the equity, and then we reinvested the equity and like double our portfolio overnight and increase our cash flow. And that's kind of the scalability way. Now, a little bit higher level, what we do, because we're actively involved in real estate professionals, is currently we use accelerated depreciation as the kind of third big impactful thing. And again, there's a lot of tax benefits, but those are the 3 most impactful things I think that anyone can do. And that's basically where you're taking a property and you're accelerating, because you take depreciation over on residential 27.5 years. Normally, that's a huge tax benefit for the property. But what you can do as a real estate professional, or if you're operating short-term rentals, is you can take a portion of that in year 1 against all income sources, against active W-2 income potentially. And that can be extremely powerful. So if you buy $1 million worth of real estate, that's a handful of single family or one multi, whatever the case is, our studies usually come in about 30% of accelerated depreciation. So on $1 million of real estate, you could have potentially a $300,000 tax deduction that offsets all of your income sources, right? And that's just accelerating that depreciation, because that's money you would otherwise give to Uncle Sam that, again, now you have to reinvest in. There's a lot more to that, like this year where it's 60% bonus depreciation, things like that. But those are kind of high level, the big, most impactful things that has helped us.
So you obviously started investing in real estate, got very familiar with the tax benefits from real estate, and that's when you were able to scale, like you said. When did this rent to retirement concept start coming into play in your career, in your investing career?
I think this was probably about year 4 of our investing, or 3 to 4. This is basically, that's when the concept was born. Not necessarily when we started the company, but we were investing out of state. So I was stationed in North Dakota with the Air Force at the time. We had bought a few rentals locally, and as I mentioned, but North Dakota is not like the highly sought after market, right? It's got okay cash flow, somewhat decent appreciation, but we started to learn about other markets where there was just like better opportunity where rents were increasing significantly more, where there's more affordability. We had lower price points on better quality assets that had better appreciation year after year, which we found out like, hey, because I think this would be true for most people, and this is what our company serves to try to help people with today, is that like it's okay to start in your local backyard, but as you grow and diversify, you do want to be diversified. Most successful investors have a diversity of portfolios and assets across the country, but I mean, it's probably likely that there's other markets out there that are more conducive to your goals or just have better returns in your own backyard. Simple as that, right? And the markets are always changing. So once you kind of open your mindset to the looking across the country at these different opportunities, you can make some bigger moves and make your goals more efficient. So that's what we started doing. And like I said, it wasn't easy at first, but we built a process to first identify markets that fit our fundamental goals, be in the path of progress, landlord-friendly legislation, low tax, all these things. We want to be in growth markets. And once we started to focus on those areas, we're like, wow, we're really making bigger moves in a shorter period of time. And that's where people are like, hey, can you help us? So a lot of our colleagues, even our first two investors, were like optometry colleagues of ours that we just talked about what we were doing. And then we figured out like, hey, we've already had the framework for a way for us to invest out of state, building all the teams, the management, the lenders, finding the local areas that fit our goals, and consistently doing that over time and opening up new markets. And so then we're like, hey, there's a larger need for people that want to invest out of state and access different markets. And then we put a team together, started marketing publicly, opening it up to other investors. And that was kind of the birthplace.
Yeah. And I mean, from my own experience, I'm located in Oregon, Portland Metro. And so I'm sure a lot of people that are listening know that the landlord tenant laws are definitely tenant favored here. And so I've looked out of state, but it is daunting because I'm not familiar with these other markets. I don't know how to identify them very well. And it would take me a lot of time to get comfortable and meet the right people in those markets. And that's where rent to retirement has bridged that gap for a lot of people that want to get out of their own backyard, but maybe don't have the time or the resources or the skills to go find those markets. How do you connect these people with these new markets that maybe aren't their backyard?
And by the way, I went to, do you know where Forest Grove is?
Of course, yeah.
Yeah, right past Hillsboro. So that's where I went to optometry school. I was in Forest Grove. So I love Oregon. It's we're in Denver. If we weren't living here, we'd probably be there, But like I said, same thing here. It's difficult to invest locally for all the same reasons. But yeah, so I guess for the investor, like our motto is to make the best deals across the country accessible to everyone, where we handle everything for them. And I'm not saying real estate's 100% passive, because sometimes people associate turnkey with, it's 100. It's not 100% passive, but it is on the passive end of the spectrum when you're talking about like tangible physical assets that you're owning. So we first, identify the markets that fit our investment criteria. Geographically, we tend to be focused in, the Midwest, Ohio, Missouri, Indiana, and then majority in the Southeast. These are more growth markets, and that's all new construction. We mainly do build to rent, single family, and small multi. And so we have fundamental market criteria that we decide on to build a team. Either we partner with local established teams from builders and managers, or we'll build our own team in that area once we've identified that that's a quality market. And then we'll offer consistent inventory, new construction inventory to our investors, that they have access. These are off-market deals. They're often steeply discounted. We talked a little bit about buying properties, some of the new construction below market value with unique loan structures that we're able to accomplish. So they're possibly 5% down into the properties or less, sometimes 0% down, because we're piecing all the things in place: the lenders, the insurance providers, the inventory, the property managers. And then our team is helping guide them through the process of first understanding investing out of state, and really what is the strategy for them. Everyone has individual goals, criteria, timelines, resources. So we want to help them build an investment strategy. If you're a brand new investor, this is your first property, Turnkey is a great option because you're avoiding a lot of those common pitfalls and mistakes. Or if you're a first-time investor out of state, like to your point, there's a lot of different things to think about: local regulations and laws. How do you even identify the right market? So our goal is to already have done the research and have the established teams where we can match you with a market that meets your goals and kind of help you walk through that strategy to how are you going to get to A to Z? Let's get you into your first couple properties. Let's make sure that makes sense. How do we maximize tax benefits? What are the creative loan structures? And how do we help you scale over time? So it's literally just tapping into our established networks and teams that are in the diversity of areas we're operating in.
And now here's a word from our sponsor. Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. So, Zach, let me ask you, as someone that in my own market, I have the team in place to buy a deal that needs a facelift and able to force that appreciation myself through renovations and then obviously renting it out and holding it in my portfolio. As an investor like that, if someone says, I'm used to that, but all I have is turnkey properties, albeit typically at a discount or below market value. Where is the benefit in terms of buying a turnkey rental, where I know one of the benefits is you don't have to deal with the headache of of renovating it. But what would you tell someone that's in a position like I am of turnkey versus something that you can afford, you can force the appreciation on?
Yeah, and I would start by saying, Trent, that it may not make sense, right? This is a specific investment model that serves a specific niche for the right investor, but it can fit in multiple scenarios for the investor depending on their short and long-term goals. For someone like yourself, who's an active investor, you're actively, rehabbing deals and forcing appreciation and then doing some creative things with whatever it sounds like cash out and then holding them as rentals and having a great ROI. That's fantastic. And that takes a lot of work and it's a full-time job. And there's volatility with that, right? And for a newer investor, potentially that could be a very risky thing and challenging thing to do. I think a lot of people actually jump into flipping too early and like get in over their head, or they just don't have the time and experience to deal with that. Where it may make sense for you though, is if you're looking to diversify into other markets over time. You have your active real estate business. We have a lot of active professional real estate investors running, 7-8 figure businesses, but they still buy with us because it helps them to easily diversify and scale their portfolio. Because buy and hold real estate, buy and hold is where you build wealth over time and financial independence. So regardless of what you're doing in an active career or active real estate business, this still provides an opportunity for you to easily and systematically diversify into other areas that make sense for you and to scale. We also have a lot of investors on, like I mentioned, on the tax side, that they're making great income on their W-2 job or their real estate business, and they just need an efficient way to buy more real estate to not take away time from their W-2 or their active business to maximize their tax benefits, right? So that could serve that purpose. Turnkey really makes sense for people that are newer investors. They want to avoid the pitfalls, newer investors out of state, people that are, they have capital, they don't want to be actively managing properties, people that want to diversify, business owners like yourself that, do want to utilize that. And I will say, there's a common theme that, or misconception, that in turnkey, you're buying at or above market value and there's no value add, there's no upside. And that's really just not the case with our, at least with our company, because we operate two ways. One, we're builders and we build our own inventory, but we also partner with national and regional builders because as a community, we have hundreds of thousands of investors in our community that are buying, hundreds and thousands of properties every single year. So we have a lot of buying power as a community. So we can go to these national builders, which we've already established, like a D.R. Horton, Toll Brothers, Lennar, whatever, and who build all across the country, and say, we actually work with their wholesale division instead of their retail division, and say, we commit to X hundred of houses that we're going to buy that year because we've cherry picked the markets that we know to be the best markets where they're already building, and we can get steeply discounted prices because of that. We're the first company to work with institutional builders and get institutional type of discounts that like a Blackstone would get because they're buying hundreds of houses, and pass those discounts on to the individual investor. So there are some creative ways that you can buy below market value and come into $30,000, $40,000, $50,000 of immediate equity where maybe you can't cash out refi day one, but you're expediting that process where you already have that initial equity to be able to do something with earlier on.
Yeah, and I think that's one thing that's really cool about your model is, to your point, you said typically if you're buying turnkey rentals, you're kind of letting time do its thing in terms of appreciation. Whereas if you are able to come in with some equity right off the bat, yes, you're going to let time do its thing, but you have some equity in there aside from just the cash that you're putting in up front, which is something that I don't think a lot of people offer or know about, at least, in this space. I didn't know about it until I did some research on rent to retirement, and obviously talking with you here today.
Yeah, we have, and if I could just go a little bit further on that trend. So, I mean, like I said, every investor has their own unique strategy and goals that they want to achieve, but our goal is to help them put that into place, right? And visualize their strategy and build that out. So, like, just to use a property example, if someone has a $300,000 property, that's probably about average price point. We have new construction anywhere from, two to 400,000, give or take. We have some stuff that's rehab that's less than that, but average new construction A-class house, 4-bed, 2-bath in the Southeast is probably 300K. It'll probably rent out between $2,400 to $2,600 a month. So have a 8 to 12% cash on cash return if you're using conventional financing. But that's standard deal structure. But if you're looking at some of these creative deal structures, so let's say a $300,000 house has a 10% incentive on it, and our incentives probably range anywhere from 5 to 12% deal dependent. But that $300,000 house with a 10% incentive, you as the investor get to utilize that however you want to. And this is where it gets really creative and interesting. And we are the only company doing these types of things because of our relationships and economies of scale that we've built. But so $300,000 house, 10%, that's 30K. You can take that as an immediate price reduction to come into immediate equity. That will help you have a lower loan amount, help you cash flow better, possibly cash out, refi, or sell quicker, right? Because you already have kind of that, you're ahead of the game with that equity. And that house will appraise all day and be sold retail at 300,000 or higher consistently. So it's true equity. But you don't have to take it. In fact, most investors don't, because the other options you can do with that 10%, that 30K, is you can use it to buy your rate down. I mean, we have people buying the rates down into the mid threes right now, which is like, we're never going to get there in interest rates again, right? On a 30-year fixed loan. Yeah. That's a lot of money to buy the rate down, but some people want to do that because then they're going to cash flow the heck out of it. Or what most people do is actually take the capital back at closing. Like, you can literally get 10% back at closing. And that's what I think where it becomes the most efficient, because that's covering half of your down payment, right? So you can buy a $300,000 house. If you're doing 20% down, that's 60K. You get 30K of that immediately back. That skyrockets your ROI and helps you stretch your capital further across more doors. And where it gets really unique is that we have negotiated with local credit unions, not in all markets, but in most, where they have some creative finance options where you can put as little as 5% down on up to 5 investment properties. These are true investor loans. These are not where you have to live in them. There's no PMI on these. Like, conventionally, you have less than 20%. Normally, you have PMI, right? So this is a true portfolio loan held in-house by the local credit unions. We've helped them develop and build out these products, and we've created a consistent pipeline so they feel confident to keep offering them. But it's a 5% down loan, up to 5 investment properties. You still have to qualify for them. It's a 30-year amortized loan. It's 10-year term, so it's due in 10 years, amortized over 30 years. No PMI, no prepayment penalty. You can refinance it whenever you want. So think about that. If we're giving you 10% back at closing on a property and you're buying it with 5% down, not only are you getting your down payment covered, so you're buying it with no money down, but you could possibly even get money back in your pocket, right? And you can use these incentives however you want. You can do half on the price reduction, half on the cash back, buy the rate down. Most people do a combination. But it's a really unique way where it's like, hey, you can actually acquire A-class new construction assets with no money down out of pocket if you really wanted to. The one caveat I'll say is that on a 95% loan, you may not be positive cash flow, right? You don't only have to put 5% down. You can put 7, 8%. There may be a sweet spot for you where you break even or positive, but just keep that in mind. You have a 95% loan. But it's all about, like, how do you structure that to make sense for you? And you can use that structure however you want. So I just wanted to go through that example.
Yeah, and I have a couple questions about that example, because I think a lot of people are hearing that, and I mean, should be hearing that as a great idea and a great way to acquire more assets in their portfolio. So if someone, let's say that's a 10% incentive, we're going to use the same example here. Say someone puts 10% down, and that's maybe allowing them to cash flow, and then they get that 10% back. Now you're able to basically have no money down aside from some, closing costs and whatnot, and still cash flow on an A-class property, right?
Yeah, I mean, every deal is dependent, right? Some will have better cash flow than others. Like we have some Ohio stuff that's like 160,000, and those are rehabbed properties, not new construction, B class stuff. Those will actually cash flow with 5% down. But yes, it's up to the investor ultimately what they want to do, right? You could put 20% down on that property. It's up to you. We don't care what loan structure you use. But in that yeah, you just kind of got to run the numbers and tweak it to make sense for you based on what makes sense for you. We have a lot of people that are high income earners, and they're actually okay with negative cash flow because they'll plan to sell or refinance the property within a 3 to 5 year period, but they want to maximize tax benefits, right? These are people that earn a lot of money. That, just like we talked about with accelerated depreciation, like you can create, if you bought $1 million worth of real estate and you had a $300,000 tax deduction, through accelerated depreciation, you could accomplish that with potentially no money down, even though you're negative cash flow. You just have to have a plan for that. And our rents in the Southeast usually go up about 6% per year, Trent, which is about double the national average. But, so even though they may start out negative cash flow, I mean, over time, the rents will increase. But yes, I think that's a possible example.
Yeah, and I do have a question on the markets that you're choosing, because you have the Southeast and the Midwest. You just used Ohio and the Southeast as examples. Obviously, the deals are going to operate a little bit differently in market to market. How do you identify your markets that you're going to get into? And I think you said you had 18 different markets right now. How are you identifying those markets?
There's kind of, and it's multifactorial. We start broad macroeconomic scale from a state level, and then we go really microeconomic into like specific MSAs and neighborhoods. Generally, we want to be in areas where we're below the median house price point, which is give or take $400K. Sounds cheap for guys like us in Denver and Portland, but median house price point, $400K in US. We want to be significantly below that because that's where your bread and butter housing is. You have less volatility in those areas. You have the highest demographic for retail buyers and tenants, right? So that's kind of where we try to be in an affordable markets that have landlord friendly legislation. That just tends to be, the Midwest and Southeast that are below that price point. We want to be in areas that have a diversity of industries. We don't want to be in an area that's just solely reliant on oil or gas. That could obviously change the economics of the area. We want to be in areas where we obviously see the potential for future population and economic growth. And the big thing, I mean, you really don't have to overthink it too much. I know a lot of people get, they think it's daunting to invest out of state, which it can be. You need to be familiar with local laws and regulations, but a big thing we look at is supply and demand. Economics 101. We want to be in an area that has an undersupply of housing and where the population is growing. There's a lot of people moving down to the Sun Belt. So the Southeastern markets are areas within Texas, the Carolinas, Alabama, Georgia, Florida. Those would be a lot of the Southeastern markets that we focus on within specific areas in the state too. Not all areas like Florida make sense. Orlando and Miami certainly do not make sense from what like our fundamentals. So those are kind of some of the things that we look at. And then like on a neighborhood basis, like we're attending city planning meetings, we're seeing where future jobs and transportation is going and looking at where that affordability metric is that makes the most sense. Because new construction, builders are building in areas where there's an undersupply, right? Or they're trying to, where there's high demand. So those are some of the things that we choose in the market. And then we build the team and, start investing in that area and then track it over time.
Yeah, and as far as the team that you just mentioned, I mean, we've already talked about the builders. We've talked about the local credit unions that you guys have partnered with. I do want to ask about insurance and property management. How are you setting those up, and are you connecting your investors with insurance agents and property managers, or are they having to go out and find their own?
Yeah, management is set up in place. We don't do any property management in-house. We did at one point, but we found, like, especially as we scaled, that like, we're better off partnering and vetting the teams that are hyper local to that area. So it's not national property management. It's hyper local to that area. People that really understand the market and are already excelling at their business. They need to have at least 250 doors under management. We go through best practices. Sometimes, we're able to even improve their management structure with like tenant screening. We're able to obviously negotiate lower fee structure, just like with the builders and the lenders. Same thing with property management and insurance. Being part of our investor community at Rent Retirement, you get discounted pricing just because of the sheer volume of business. And so we find property managers in those areas, and they manage the properties. These are all long-term rentals. We do have some short-term rentals, but that's not our main core competency. We focus on long-term rentals. You don't have to use these property managers, but they are there for you to use, and most people do. And if you want to fire them or something happens in the future, we have other recommendations for you and help you make that transition. And same thing with insurance providers. We have a diversity of different insurance providers that you can get insurance quotes from. You don't have to use them, but we've discounted price points and premiums to maximize the cash flow on the property, among other things. And I will say on insurance too, because that's a question that always comes up, especially when we talk about like Florida and Southeast, is people are always like, well, insurance has gotten so crazy expensive. In some areas, yes. Usually it's flood zones or areas that have been remapped as flood zones. And the homes that are being hit the hardest are the old homes, like pre-1990, a lot of times where building codes have changed. And then all of a sudden it's like, those buildings are not built to standard. Those are the houses that are having like the 3x in insurance costs. Our average insurance cost on a brand new constructed house in Florida is $950 annual premium. And that's because they're built not in flood zones, and they're built to current standards, right? Current building code. They're concrete block homes that withstand 150 mile per hour winds. So insurance is still relatively affordable, if you are not in flood zones and you have a new construction house.
Very nice. Well, Zach, I want to ask you too, rent to retirement sounds like a no-brainer for someone that is, earning good income, wants to get into real estate, wants to get out of their own backyard and diversify into different markets. What's your favorite thing about your business and what you're able to do for your investors?
I think for us, what's fulfilling, because we're not in this business to make money. I mean, admittedly, probably at some point we really were, but we've been successful every single year. I'm passionate about real estate. I'm passionate about helping people accomplish their goals, and hopefully people can see that. We have a lot of 5-star reviews online that people talk about the time we spend with them to help them build out the strategy. But if you remember, we built this business just kind of by accident in the early years out of our own investing. So I love real estate. I still enjoy optometry, but like I said, real estate, I think you can just do more, right? And you can create a lifestyle. And I think that's what a lot of people want to ultimately do, is create a lifestyle where, and it does take work, right? Even if you're buying turnkey, guys, this is like, real estate is real estate. You will have tenant issues from time to time. Like it's not 100% passive. I don't believe there truly is anything that is 100% passive. But what we really enjoy about working in the industry that we do is how impactful of a difference we can make on people's lives when we teach them about the things like the tax benefits, when we bring these discounted new construction deals and to people and help them build a strategy. And it's not all perfect, right? It does not all work out. It's not all sunshine and rainbows. Real estate takes work and takes grit. It's a long-term game, but if you stay committed, I believe it's the most predictable path to wealth. And I just love the stories of seeing people where it's like the brand new investor that was nervous about getting started or investing out of state. And they may have been, maybe a little annoying at first because we had some of the conversations, but they come back a few years later and they're like, hey, we made a huge impact. And a lot of times those people go out and build out their own real estate business, but we gave them the foundation to help them get started and the confidence to go out and do something great. And being able to have an impact on people's lives like that, when we hear those stories, like that's the self-fulfillment and the reward. That's like, I love that. Same thing in healthcare. I love helping people see, and that will change their life for a better. And I think you can do the same thing in real estate. I mean, I truly believe that. I
love it. Where can people hear more from you, Zach, and connect with you and your business, Rent to Retirement?
We always want to drive people to our website. So that's renttoretirement.com, renttoretirement.com. We have, our podcast, our YouTube channel, a bunch of investment calculators, market data. Even if you just want to, get access to some of the lenders that we talked about, because you don't have to go through us to use them. We put out a lot of information available to the general public. If you're listening to this audio, you can text REI to 33777 and set up a time with our team to help you build out a strategy. We don't charge investors anything. We make our money through building and selling houses. So we spend as much time as we need with you to help you build out a strategy. And yeah, check out the website and all the content we put out.
We'll make sure we link that. Zach, thank you so much for sharing today and joining our conversation.
Trent, it's been a pleasure. Thanks for having me on.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.